Biofuels, a hot investment opportunity in an inflationary environment. Biofuels are fuels that are derived from biomass, such as plants, animals, or organic waste. They can be used as alternatives or additives to fossil fuels, such as gasoline, diesel, or jet fuel. Biofuels have several advantages over fossil fuels, such as reducing greenhouse gas emissions, enhancing energy security, and creating rural development opportunities. However, biofuels also face some challenges, such as competing with food production, requiring large amounts of land and water, and having lower energy density and efficiency. One of the key factors that affect the investment potential of biofuels is inflation, which is the general increase in the prices of goods and services over time. Inflation can have a significant impact on the cost of capital, which is the minimum return that investors require to invest in a project or a company. The cost of capital is influenced by factors such as interest rates, risk premiums, and tax rates. In this video, we will explore how inflation affects the cost of capital and the investment potential of biofuels and other sectors, such as value and growth stocks. How inflation can lead to a firestorm in biofuel prices. One of the main sources of inflation in the economy is the rise in the prices of commodities, such as natural gas, oil, and corn. These commodities have a strong interrelationship with biofuels, especially ethanol, which is the most widely used biofuel in the U.S. Ethanol is mainly produced from corn, which accounts for about 40% of the U.S. corn production. Corn is also used for animal feed, which makes up another 40% of the U.S. corn production. Animal feed is composed of about 50% corn. This means that if the price of natural gas or oil rises significantly, it will have a ripple effect on the prices of ethanol and corn. Natural gas is used to produce nitrogen fertilizer, which is essential for growing corn with high yields. Oil is used to transport and process corn and ethanol. Ethanol is also used as an additive to gasoline, which makes it more competitive with oil when oil prices are high. Therefore, if natural gas or oil prices increase substantially, it will increase the demand and price of ethanol and corn. This will in turn increase the prices of food and animal products, such as meat, dairy, and eggs. This will create an inflationary firestorm that will affect consumers and producers alike. How inflation affects the cost of capital. Inflation can also affect the cost of capital by influencing the interest rates, risk premiums, and tax rates that investors use to evaluate their investments. Interest rates are the rates at which investors can borrow or lend money. Risk premiums are the additional returns that investors demand for investing in risky assets over risk-free assets. Tax rates are the rates at which investors pay taxes on their income or capital gains. In general, inflation tends to increase interest rates, risk premiums, and tax rates. This is because inflation erodes the purchasing power of money over time, making it less valuable. Therefore, investors demand higher interest rates to lend money or lower interest rates to borrow money. Investors also demand higher risk premiums to invest in risky assets or lower risk premiums to invest in risk-free assets.